Good morning, guys. Hope you guys are well. Today is Friday, the 19th of April, 2024. Markets took a big beating today. Actually, if you remember, yesterday, Thursday, was when we had news of the Israel and Iran conflict escalating a little bit, and the futures were down pretty significantly in the late evening time frame, about 7 o'clock, 8 o'clock Pacific time. And then they recovered somewhat, and then they went lower after the trading day began to much, much lower than what the futures indicated. So just keep that in mind. But I've been telling you about this for the last couple of weeks at least. Market ready for a pullback. How much lower it goes, we don't know. The Nasdaq had gone up 34% from October to end of March, and then in April Q2 of 2024, it's pulled back about 6% to 7% in that range since then. So that's been a pullback, which is much needed pullback. At 10% range above the highs, it'll be a correction. It's not yet a correction. But the shorts are working very well. All the shorts that I had mentioned to you guys seem to be working okay. All right, so one of the companies that I think a lot of people have asked me and talked to me about what I think about this company going forward is Google. So I thought we'll take a quick look at Google overall. Now, most of you probably know Google. What you probably also perceive of Google's threat from the advertising business coming from ChatGPT or generative AI, with all the hundreds of so-called experts on Twitter or X talking about the fact that Google is going to die. I thought we'll take a look at the business overall, where it is right now, where it's headed, where do they make money, where are the challenges for them to make money, and how the market evolves going forward. Okay, so in a nutshell, 2023, last year, this is as of Q4 2023, Google makes roughly in the range about, look at this, they roughly make about $360 billion in total revenue in that range. Now, Google search, which is if you go to either google.com or you use the Chrome browser, or if you use the Safari browser, or practically speaking, you use the Safari browser on your iPhone or your Google phone, Android phone. Any one of these, if you use them, then you will be using Google, and that revenue essentially goes to search. When you go to search, about 27% of all searches actually have ads that are monetizable. And the click-through rate for ads, for showing the ads, you don't pay any money, but for the display of the ads, but when the ads get clicked on, that's when you get charged by Google. Now, on Google's website itself, those ads show up. Besides that, Google also has a global network of websites. Now, for example, back in 2015, 2014, when I used to run my own blog, it used to feature Google AdSense and AdWords. Those are two products, AdSense and AdWords. Essentially, you can go to Google and you can type something and you can see ads. Or if you want Google to show relevant ads on your website, then you capture a piece of code, you put it onto your website, it actually shows that as relevant. And if anybody clicks on those, then it gets that. So Google has partnerships with Mozilla, has partnership with Safari. They pay money to these people, including Apple, to be able to send traffic to Google so they can monetize the ads. So on Google websites, that's nearly 57% of the revenue from Google advertising and third-party sites. They make another $30 billion in revenue for the year. YouTube itself is a $30 billion business. That's a little less than 10% of the business. Now, the Google Cloud business is about a $33 billion business. Both of these are comparable, so 10% each. So yes, advertising is nearly 60%, 67% of Google. This totally makes up about 67% of Google. In fact, if you take YouTube as well, that makes it 77% of Google. So but very, very small amount, which is roughly about a 20-25%, is actually YouTube subscriptions, Nest products, Google Play Store, which is competitive to Apple's App Store, where they get money from advertising on that as well. And there are small bets. There are a bunch of small bets. They make a very small amount of money, about a $2 billion, a little less than that. That is from Nest, which they acquired, from Verily, from Calico. All of these are other bets, is what they call them. They still make a ton more money on AdWords than anything else, just to give you a little bit of context. So 57% of the business primarily comes from AdWords and from AdSense. Now, AdMob is a mobile application system, advertising system that they acquired back in 2000, somewhere in 2000, not sure exactly when. I suspect it was probably in the mid 2000s, 2005, 2008 timeframe, and they've done very, very well with that as well. They also acquired DoubleClick, which is a ad platform for not just search ads, but also for display ads. So Google has a lot of capabilities. Now, the key part that you have to remember is almost anybody who wants to advertise on Google has to very easily set up a Google AdWords account. Very easy. You set up an account. It takes very little time. So whether the company is small or whether the company is very, very large, all of them, some of the large companies work through agencies so they can consolidate their buy, manage their purchases, make sure that the right keywords are put in. So, for example, Allstate might advertise on keywords for Liberty Insurance, or they might advertise for insurance near me, any of those ads. Essentially, you bid on keywords. The way the system works is you have to be able to say, here are the words that I want to bid for. Here's what my ad copy needs to be. And you essentially will put a certain amount of money saying, if someone comes in, I'm willing to pay up to $5 a bid, $6 a bid to have me show in the ad, and then the click through comes in through. You can play by click through or you can play by display. You can pay by both ways in Google actually. So that's how the basic system, which is mostly AdWords, work. So on the consumer side, you go in, you might type insurance. And then on the top, as I will show you a little bit later, on the top, you'll see a bunch of advertising. And then the rest of them, the search engine results page, SERP is what it's called. The search engine results page shows now nearly 4 or 5 different ads. It used to be 1 or 2 ads, but now it's nearly half the page is filled with ads. Now, those are bid on by advertisers. When someone types a keyword, or they might say Allstate, or might they say State Farm Insurance, then competitors also bid on those spots. The first spot typically gets about 67% of the click. But some ads, which might be a little bit better, might get clicks a little bit later down in the food chain. So when you bid on that position, you literally are bidding against yourself in some cases, or in other cases against others as well. So it really makes Google a non-linear way to make money on the advertising. So when they bid on that, sometimes it might go to $5 and $6 and $7. Advertising now, with the number of people, the reason why Google is so successful is because it displays intent. When someone goes in and says insurance, it means they're looking to be able to buy insurance. So it's a high intent ad. So the conversion tends to be fairly good as well, meaning that they're looking for it. Now, the conversion obviously might depend on your products and may not depend on your products, etc. So that's the basics of Google advertising as well. So if you look at the spread of the money, nearly 50%, almost 50% of the money is from Americas, which includes United States, Canada, Mexico. All of these other is about 5%, which includes South America. Then the rest of it comes from Europe, which is about Europe, Middle East, and Africa. It's about 30% and about 17% or so from Asia Pacific. That's the distribution globally of the money itself. Now, the Google's money machine, the way the business works is advertisers come, they want to be able to drive people to come to their website or to download an app, whatever it is that they want to do. They will place and bid on ads. So when you have a search that is done, the intent is fairly high. Then what happens is, to a large extent, you will actually get those ads and you'll click on those ads, and that's how conversion happens. Now, when the network, if you are a content website, let's say you're ESPN, or let's say you are even my blog, I'm a content owner, I'm a media producer, I produce content. What happens is you can sign up for an AdSense account. Advertisers go to Google Network, the Google Ad Network. They keep their ads, and then on a real-time basis, ads are shown based on the content that is produced by the owner. And once that happens, then these ads have a click rate, which then the consumer clicks on. That is charged back to the advertiser after Google takes a little bit of a cut over here. That's the Google Ad Network. And then the owners get the remaining amount of the money. So that's how that portion of it works. Now, if you look at it comparably speaking, just to give you a little bit of context, how do a lot of these people make money? The best business, practically speaking, is actually the most defensible is Microsoft. They have an extremely good spread. They're very well diversified. It's very rare to see a business like Microsoft doing so well in so many different categories. They make money on Office. They make money. We talked about this a couple of days ago, so I'm not going to go through that again. They have a very well diversified revenue stream. The most concentrated, obviously, is Facebook. They make a ton of revenue just from ads, social ads. So a little bit different than Google. The intent is a little bit different. The intent is more specific in Google. When you go to Google's websites, you know what you're looking for. You're searching for something specific. Whereas if you look at the Facebook side, you're more scrolling, you're looking for things to be able to do. But the intent seems to be coming now with Instagram fairly well as well. So concentration of revenue, Google is second only compared to Facebook. It's about 67 to 70%. It's not 88% overall. But if you look at it overall, 25% of it is coming from other bets and cloud revenue. So this is a little bit dated, but Facebook is extremely concentrated, next only to Amazon, then iPhone, then to a certain extent Google. So it's about 67%. They've reduced their swing very, very well. Most concentrated is Facebook, least concentrated, very well diversified is Apple. Now, Google has over 370 different products. So it's very hard to be able to say which products of Google, but there are top five that matter a lot. Number one is Google search ads. Number two is YouTube. They do a ton of work with YouTube. Then they have a whole Google suite of products. Now, a lot of what Google does is actually give you free products. Google Calendar, Google Mail, Google Docs, etc. You can sign up for a free account if you want, but if you want it for your business, then you'll end up paying for Google Workspace, which they will charge you money for. Typically in the $12 per month phase, $8 per month is one plan, and even higher from there. They give you a lot of products for free. So Google Photos is free, Google Chrome is free. The way they make money is by advertising. And even Google Photos actually now has other alternative products that they give you from various different things. So what drives Google to a large extent is just ads. They're trying to diversify away from ads. So this is what I was talking about in terms of search engine. Let's say you go to a search engine, you type a specific search keyword, social media marketing in this case. Now this one is showing about 3, but really now it's become about 4 to 5 ads. These are ads placed by MailChimp, placed by Zosimus, etc., other people. They are bidding on this position. This is position number 1, and this is position number 2. Now, there are other people who these are called organic results, by the way. These are not people that pay for them. They are essentially just going ahead and making the right keywords appear so they appear on the top of the point in terms of keyword. But these two positions are bid on, meaning MailChimp might say, I'm willing to pay $5 for it. If Zosimus was willing to pay $5.10, then they would show up a little bit higher. But also ad quality matters to a certain extent. So it's not always only the highest bid. It's also it's actually the ones that Google thinks is going to convert the best and make them the most money that they will show up on top, which they believe is good for the users. So that's the way to think about it. When you search on the ad, this is essentially bid on. This is a ongoing auction that happens in real time. And so marketers will set thresholds. They'll say, I'm willing to pay up to so much. You can bid up to so much. And my total budget for the day is so much. They also worry about return on ad spend. If they spend $5 on the ad, then about 10% of, let's say 10 people come from that ad. And if so 10 people come from the ad and 3 people actually are them for pricing, one person ends up actually buying, then you look at that conversion rate and the funnel that appears. This is essentially the return on ad spend. How many people came and bought? That has to cover the cost of your ad spend. Think about it that way. Now, the second portion of the business that I talked about was Google's traffic acquisition cost. That continues to go up. Traffic acquisition cost is essentially the money that they pay to third-party websites for hosting ads so that they can place those ads and they can get the conversion, or to Apple, or to Netscape, not Mozilla, which has the Mozilla browser, and a whole bunch of other people to be able to get the information of placing the ad in the right place. Now, the TAC rate has consistently gone down, but the amount of money that they're paying is a lot higher. So Google is starting to depend a little bit less on third party, but the big difference is even with all of this, Google is still getting more search on an ongoing basis. Okay, Google TAC rates, why they matter as they start to pay more and more for each dollar that Google gives out to a traffic acquisition scenario, the amount of money that they make is less. So the margin on that is they make is less. Google is an extremely profitable company. Gross margins are in the 80% for search alone. But now with all the other bets, gross margin has started to get slower with hardware and so on and so forth. So keep that in mind. As the traffic acquisition costs start to go higher, their margins drop a little bit. That has been going up a little bit, but they've been very, very smart about doing that on a consistent basis. Now, who gets the most amount of money to Google for ads? Who pays the most amount of money to the ads? You will find on an ongoing basis that this is the portion, jobs and education, the average cost per click is about $2.40, $2.50 right now. And the display network essentially 60 cents, means for every 1,000 people that view the ad, you'll pay 60 cents. In some cases, it gets a little bit higher as well. So you look at skyscraper ads, or you look at banner ads, even those are some things that Google can do with Google DoubleClick, which was an acquisition that they made. Across the board, you'll find the most expensive ads are coming from insurance companies. They're coming from travel and tourism, people like Expedia, and a whole host of others after that. But the biggest amount of money is actually from a very few concentrated sort of 5 or 6 different industries. Now food is becoming as well. In a nutshell, if a user comes in, they can't find something, they go to a publisher or they go to Google. Google essentially takes that money, they get advertisers who are interested in it, and they try and help you get to that point. And Google keeps a certain amount of the money, they give the publisher the remaining amount of money. Now, the dominance of Google from a ad standpoint is significant. Even with ChatGPT in the last year, and I wouldn't, yeah, I could say a year and a half. It's been November of 2022, so April 2023, almost a year and a half. Even with that, Google's dominance in the search engine side hasn't slowed down. So for all of the people that are saying, oh yeah, eventually in 10 years, Google is going to completely go away, even now, ChatGPT will start to work on advertising model. The money that you can make from advertising, whether it's ChatGPT or whether it's Perplexity, another system that I use, even they're starting to focus on showing ads because that's where you make really the money. The subscription business is not good enough. I remember about 10 years ago, Marissa Mayer, who was a chief executive or a senior executive, sorry, not chief executive. She was a CEO of Yahoo, but before that, she was a senior executive at Google. She said, we actually did look at trying to make money primarily from subscriptions, but the amount of money that they would make was going to be capped by the total number of users times the subscription. That's essentially the reason why Netflix is also moving away from a business that is primarily subscription alone to subscription and advertising. You'll find that both of them are coming into play. So Google will do the same thing. They make a lot of money in ads. They will start make money in advertising and also in subscriptions as well. So that mix will be fairly good for Google, to keep that in mind. Their search engine market share has not reduced at all. Sorry about the noise at the back end. A bunch of guys are just cleaning up on our lawn, so I apologize for that. Now, if we look at the search engine market share, it has been consistently strong. Even after Google had competition from AI-powered ChatGPT from Microsoft, they've gone literally nowhere, right? So the market share hasn't significantly gone higher it went up for about a month and then everything came back again down. So dominance in terms of market share, and I know a lot of people are saying there are nearly 20, 30, 50 million people already using ChatGPT. The use cases that I have seen, by the way, the 100 million people that pay for ChatGPT right now, nearly 50% of them are actually students. They're actually using it for doing their work, doing their research, studying, learning. They are not, yes, they are reducing the number of searches that they do on Google, but the advertising that Google has gotten from that has only started to increase. Now, advertising, unfortunately, is a cyclical industry, depending very much on the overall economic conditions. As the economy does better, advertising does better, and if it does slower, advertising is slower. Unlike Microsoft, which tends to weather these recessions fairly well, Google, given its size, is just so dependent on this business. Remember, I talked about it before. Google's advertising, which includes Google search, traffic acquisition costs from network, display ads, and others as well, and YouTube itself make up about 60%, roughly in the range of about $205, $220 billion in total revenue. That means essentially they're getting, if you will see in a little bit when I show you the market share, the total amount of money spent is about 800 billion. They get about a quarter of all the money being spent online on ads. They're going to be hit by the larger economy. Okay, global trends in terms of YouTube ads, they've gone to nearly 33 billion. Look at this. They were only about 8 years ago, about $6.5 billion. They've grown 5x in the last close to about 7 years. This is the forecast number. And then by ad spend, the difference between Google search ads versus YouTube ads, you'll find a lot more retail people and CPG, consumer product goods, spending on YouTube ads for branding. That's a brand-based ad versus search, which is an intent-based ad. Keep that in mind. There's a little bit of a difference. The advertising growth, unfortunately, has slowed for YouTube over the years. Now, the question is why? A lot of people actually believe that it's because of the kind of video content available on Google and, on YouTube, and a lot more people competing with Google, YouTube on the Amazon Prime Video front, on Netflix front, and everything else. I don't think it is that. This is just everything to do with the economy. The economy does well, Google grows dramatically, and YouTube grows very well. As the economy starts to do badly, and right now we had a little bit of a challenge. The economy, US economy, GDP wise, is still growing well, but the inflation has hit a lot of these people so much, especially in the retail side, that they're trying to find a way to squeeze money out as much as possible. And so that growth has dramatically reduced. Now, worldwide advertising revenues of Google on a quarterly basis growing dramatically, but it's very cyclical. You can see this. It goes up early part of the quarter, and it tends to slowly go all the way to Q1. Again, Q1 to 2020 slowly grows. Again, Q4 is the best quarter. That's usually what happens. Look at this. Every year, Q1 is the worst, and then technically this Q3 tends to be a challenge as well. So Q2 is good compared to Q3. Just look at that consistently. It's always been the way. Q1 and Q3 are the tough quarters for YouTube, but it's been doing fairly well. Google AdSense, I talked about it before. If you're a publisher, if you're New York Times, you want to place ads on your system, display ads, and even search ads, Google can help you that, and you can make money by placing those ads. Now, of the total market, digital advertising versus analog. What is digital versus analog? Out of home, which is you see billboards, television advertising, all of that is usually considered analog advertising, linear TV, for example. Now, digital advertising has been growing dramatically. It used to be about 40% of the market, 40% of the market overall. Now it's gone to 60% of the market. It's just completely flipped. That's the traditional versus analog. So it used to be a little less than 50% in 2019. This is only going to go higher. This is going to eat up a lot more. It's probably going to get to the 80% range, I think. It's a lot more effective. It's a lot more measurable. More people are spending time more online. So the non-digital advertising, traditional advertising is just not working. Radio, linear television, out of home are the three major big out of the digital area advertising. That's also going to add the digital with podcasts and so on and so forth. So it's becoming a lot more important for Google as it starts to grow. The advertising spend overall, 870 billion worldwide. Within the US, about half of that 500 billion, of which in the US itself, Google makes close to about 200 billion. Tremendous amount of money just in advertising. Now, the percent change obviously is dropping quite a bit on an ongoing basis, but still, the amount of money you can make from advertising worldwide is tremendous. US digital advertising spend is about 400 billion. Almost half of it goes to Google. Other half of it probably goes it goes to Meta, which is Facebook. So both of those companies probably make up about 80%, if not more. And then there's another small percentage over here, which is Amazon, and all the other guys make much less than that. Now, the third part of the business, we talked about first part of the business, their own traffic on their own websites, and then YouTube. Second part of the business is AdSense, so third-party websites. Traffic acquisition costs are important there. The third part of the business, which is YouTube's growth as well, the third part of the business is Amazon Cloud, which they compete with, called Google Cloud. In this space, Google is a number 3 provider, and they will continue to be number 3 for the foreseeable future. They're growing at about 19%, about 33 billion. They're trying to invest fairly heavily in AI overall. But now, the big challenge for them is even with this growth, you see it, Amazon is about 31% market share. The one that is catching up to it actually is Microsoft, and they're probably going to overtake Amazon AWS in probably the next 2 to 3 years. Google will continue to be a number 3 player, I believe, in this space. All of these guys don't matter. To a large extent in the cloud, these guys are all just bit players. They exist to be able to give them competition. And of course, you don't even see Dokken here, DigitalOcean, which is probably like this. So the 3 big players, AWS, Azure, and Google. Azure is going to get to be number 1 in about the next 2 to 3 years. AWS is roughly about a 90-something billion dollars, between 90 and 100 billion dollars, 2024. They probably get to about 10% to 12% growth is what they're estimating, about 100 to 115 billion dollars. Azure, they don't give out numbers, but they're growing at about 20%, so nearly twice the growth of Azure, twice the growth of AWS. If you remember when we talked about the business yesterday or day before yesterday when we covered Microsoft, the whole intelligent cloud business, for which includes the server products division and everything else, is roughly about a $30 billion business on a quarterly basis, so about 120 billion. That includes not the other stuff as well. Microsoft is most likely in the 60 to 70 billion dollar range on the Azure cloud itself. And I think in 2 to 3 years, almost every analyst thinks based on their growth rates, they're going to overtake AWS. Google, on the other hand, is going to continue to be, they're about a $60 billion business, 45, 50, something like that. 33 billion was last year, 35 billion was last year, 32 billion. So they're probably going to go about 40 billion. We get 40 billion, yeah, 40 billion range, but half the size of these other guys. Now, the trend of the market share side, Amazon has been going down. Microsoft has been going up. Google has been going slightly up, but that's because they're taking share away from the other players, primarily people like Oracle, Alibaba, and IBM. The market for cloud computing itself is fairly large. So this is going to be a $2 trillion market by 2032 is the expectation. It's already about 800 billion right now. So if you get to 2 trillion, that's a significant opportunity. Even if they're at 15% market share, that's still growing from roughly about, let's see, 33 billion, 40 billion this year, 2024. If you look at 2032, roughly about 8 years out, and if you do a CAGR of about 8.5%, that roughly equates to about 117, 130 billion, something in that range when I did the math. 120 to 150 billion dollars is what they will make just from Google Cloud in an 8 year time frame. Now, the last part of the business is what everybody talks about quite a bit, Android, which is the operating system. It's open source, quote unquote, meaning that you can, as a Google license it to you, you can make changes to it. Most of the Chinese players have just taken it, cooperated, and done whatever the hell they wanted with it. But if you are a Samsung, if you are Xiaomi, if you're one of those, then you have to be able to play by Google's rules, which means your search engine has to be Google. Except in China, they actually take that and they bastardize it and they use it in their own systems. But Android is the number one in the world overall, except in specific countries. In Japan, they're about close to 60% market share. They're mostly Japan is mostly an iOS system. US is nearly about 60%. The UK is a little more than 50%. Everywhere else, it just drops dramatically in terms of iOS. And Android is the dominant operating system for a lot of these. In China, Android, but really this Android green area is actually completely bastardized by them. They use their own systems in place. Now, the mobile operating system overall, Android overall, worldwide has about 70% market share. iOS is about 30% market share. This is all variations of Android, though. This is not the pure Google straight out of the box Android. In the US, which is the dominant market for advertising, which is what Google makes money off of, still iOS is doing much, much better than Google is. Google is actually dropping. Look at this trend line. This is mostly trying to go down, whereas this is mostly trying to go up. They dropped a little bit, but they're going up. Now, by operating system overall, 74% Android, iOS is about 30%. Google Workspace, I talked about a little bit about it before. They license this to businesses. So this competes with Microsoft Office Productivity Suite, Microsoft Word, Microsoft Office, Microsoft Presentation, PPT, PowerPoint, and Microsoft Excel. Google has their own version of email. They have their version of Calendar, Google Drive, which is a OneDrive competitor, Google Meet, which competes with Microsoft Skype and Zoom. And Microsoft still makes a lot more money on this than Google does. But the number of people, the number of companies that use Google is a lot more than number of people that use, because the number of end users that actually use it even for free is a lot more. But most people still use Office. Office is still the dominant system overall. Now, Office productivity software, Google apps tend to be fairly dominant only because of the fact that a lot of smaller companies, when they get signed on, they start with that and then go from there. The market share doesn't actually equate to the amount of money that they make. This is just a small, medium segment that they tend to do fairly well. There are a few big companies that use Google's suite, but far and few between. Productivity software itself is expected to be a $200-300 billion market by 2032, and Microsoft and others will continue to make a lot of money. Now, Alphabet's total operating costs in terms of the capex that they spend on the data centers and the amount of money that they spend to keep their systems up and running is fairly big part of their costs, besides the payroll. They do spend about 7% of their money on other bets. These are what they used to call moonshots, but now they call other bets. But 60% of the operating costs of the total 93% total cost that they spend is just on driving revenue within those. Now, the other bets is what a lot of people also concentrate on. What if Google can turn on Waymo, which is a part of Google? You can see this in a very small thing over here. I don't know why it's smaller than some of the others, but Waymo over here is the one that is creating a lot of noise with autonomous cars. They're way ahead. They're way ahead of everybody else in the market, including Tesla. They already have these systems running in Phoenix. They have it running in multiple different cities, and they're expanding those to a lot more regions. That's probably a better area, better bet for them to make. And it's most likely that once they get this in place, they might either license it themselves to the third-party companies, or they might go ahead and start to offer a competitor-like solution to an Uber, but they want to partner with Uber as well. So probably do a little bit of a mix of both on an ongoing basis. This is the biggest cost of even though this makes about $2-3 billion in top line, now last year it made 1.5 billion. They lose about 4 billion just because of these other bets, and they've gotten smarter about managing this more effectively. What are some of these other bets? Lifestyle, sorry, not lifestyle. A lot of health related, such as Calico, Nest, which is an acquisition that they did for smart home and IoT devices. Most of you have seen those thermostats, Nest thermostats, and all of these together. I'm not going to go through every one of them. Google Capital offers equity funding. Google Ventures, actually an investment arm of Google. So they have a suite of different things that they can do from the other bets standpoint. Total revenues for the quarter ending last year, 2023, was about 69 billion, growing at about 3% year over year. So that's the big challenge for Google. Revenues are slowing. Now, my perspective is that it's slowing because the overall market has been slowing. It's not because that they're losing share to anybody or because that Microsoft is taking away share. More people are using ChatGPT, so they're not using Google. Then Google ads are not growing. Overall advertising market has been slowing. Now, why has Microsoft Meta done so well? Meta is still growing at single digits, but they've operationalized themselves so effectively with efficiency that their profit is much higher. That's why Meta stock actually has gone up a lot more. They decided to focus less on this metaverse, which didn't make a lot of money, and optimize the cost there effectively. So net income, very healthy, 25% in operating margin. This is phenomenal. It used to be 30%. It's gone down to 25%. They'll get it back to 30%. They've already committed to that, and they're actually cutting costs very, very, very quickly. So I think they'll continue to do that very, very well. Roughly about a $15 billion net income. Throws out a lot of cash, this business. For the quarter ended, where do they make money? We talked a little bit about it. 40 billion comes from search. Another 26 billion comes from YouTube ads, Google network, which is through the third party. Total advertising is about 50 billion of the 60 billion. So this is a lot of money that they make just with advertising. And then all of the other cloud itself is about 7 billion. This is the other bets, if you will. This is the other bets, sorry, other bets. Total amount of money is about 67 billion for this is a lot of employees. That's what they've got to focus on a little bit. Similar to Meta, if they start to optimize this, get this under the 160,000. Look at this. Revenue grew. If you look at this is 3% revenue growth, right? This is 3% revenue growth, not even 3%, $1 billion, let's say, on the quarter-on-quarter basis. And the employees grew by 30,000. That's the big problem. 2022, they had 160,000 employees. That grew to 27,000. Okay, whatever. The 20% growth in employees for 1% growth in revenue, that's ridiculous. That's where they should optimize a lot more, and I think they will probably get back to the top again. So that's Google, just as an overview. Now, what we're going to do is go through our 5-step process and see what we like in the stock, what we don't like in the stock, and how's it doing overall. Okay, we always start with the fundamentals and financials first. I'm going to take a little bit more time this time to go through this. Might be a little bit of a longer video. I think you'll appreciate some of the things that I'm trying to do with this overall. So let's go through that in a little bit. Okay, annualized income statement first. From $100 billion in 2017, $111 billion, 20% growth, slowed down, grew very well, little bit after COVID. This was when advertising could do no wrong, and then now back down to single digits. They've got to get this to double digits. So 3x for a company the size of $100 billion to grow nearly 3x is phenomenal. Very strong margins in the 60% range, net margins in the 25% range. EPS has been growing. EBITDA is very strong. And the diluted earnings per share actually grew 30% last year. Not bad. They're optimizing, but they've got to optimize even more. Last few quarters, this is why it's doing a little bit better, given that it's grown about 17, 14%. It used to be very, very bad. Now it's actually doing a much better job of getting back to growth. Income statement is getting better. Still good margins. Net margins are good as well, about 0.25%, about 25% net margins. Strong balance sheet, very strong balance sheet. $176 billion in cash, literally 20 billion, 30 billion in debt. Cash flow that throws cash like it's got no tomorrow, 20 billion. This is what they should be at. This was a little bit of an anomaly. Why does Google's capex go down or up a little bit? Because they make a lot of commitments towards Google Cloud, data centers, and also growing the advertising network across the board in a lot of different places. Valuations is one of the best in the industry. This is 26 for a company growing at 14% with such a strong balance sheet, and price to sales is a very strong 6, which very, very good actually. 56% gross margin, 25% net margins. Actually, gross margins have been, let's see, they've been mostly flat. If I draw that out, see, gross margins went down and then got back up again. They're mostly flat, I would say. That's how I would call it. This is the gross margin line. You can see that across the board. I'm going to remove the price to earnings because that hasn't been very useful. The price to cash flow hasn't been very useful. Look at that. That's the gross margin side. It's been fairly good. Let's look at net margin. Okay, this is net margin. Net margin is getting a little bit better, but it's all very, very similarly mirrors this. That means operating costs have been very much in line overall. On a scale of 1 to 10, I'm going to give this an 8 or a 9. Very strong, except for the growth. If they get the growth a little bit higher back again, this is a phenomenal stock. Okay, I'm going to skip all the stage 1, which I think by now you've gotten to. This is a strong stage 4, and this is a strong stage 1. So on the long-term monthly chart, this is actually on a stage 2. It's actually on an uptrend markup. All right, let's go to the weekly chart. On the weekly chart, there was a lot of resistance here for sure, 151 zone. It's just gotten past that and then come back again to that 151 zone. So there was quite a bit of resistance here. It moved past that. It should have gone a little bit higher because it actually moved past all this resistance. It didn't seem like it did a very good job. Let's look at the monthly chart again, see if that was actually that's the previous high. So try to move beyond the previous high. This was in 2021, right? See, when was this? Yeah, 2021. So just after COVID moved up very, very high and then tried to move back up again. It seems to have broken that barrier, but seems to be coming back a little bit. Probably retest this, but there's a good amount of resistance to go down below 150 is my trend. But then the shorter term trend line, look at this. This is the shorter term trend line. The shorter term trend line is here and no specific patterns, but this is also an uptrend. Good uptrend there. Now let's go to the weekly chart. I'm going to remove these other trend lines. So now we know that the longer term uptrend is up and to the right, which is positive. So this would have been the resistance over there, but now hopefully this becomes support. It's actually not become the support. This should have been the support. 153.94 should have been the support. Let's get it's within the range. So this zone should be the support zone for Google. It should try and stay within the zone, maybe even to the 146. No, not 146, the zone, 149. If it goes down below 149, it breaks the thesis to a large extent. So still in an uptrend. This is actually a downtrend right now. It's retesting this zone. Where it heads up is in difficult to be able to say, but probably retest this red zone and then move back up would be my expectation. Earnings are coming out next week, actually. It's on the 25th. I expect a good earnings report. It could disappoint me. That could be the case, but I expect a good earnings report. A lot more focus on being operationally very, very efficient. They're consolidating their AI teams. We didn't talk about that actually, but that's not part of the technical analysis portion. This is actually going down. That's where the RSI and the MACD seem to be integrating. This is going to go down. It's going to retest this. I'm hoping that it doesn't go below the 148 zone. But even during this pullback period, this has not gone up so much. So it's actually not pulling back way too much. It's done a pretty good job. 160 was the top. 160 was it 160? 156 was the high. And it's from 156 in the last few days, given everything in the market has pulled down. This has done a very good job of just coming down a few points down from 156, which was the 52-week high, 160, which is the 52-week high, down to about 152, 153. Very small pullback, not even a 5%, not even a 3% pullback. Good pullback, actually. But these are pointing downward. So I expect it to come back here, revisit the 150 zone, get a little bit of support here. So it's retesting it, goes up, tests it, retests it, and then should try and make a move back up again. I think they will do that. MACD is pointing down, so is the RSI. So this is going to move down. This is going to move down, probably hit the 149 range and then try move back up again. Now, let me tell you why. One of the things that is exciting about this, I'm going to go to my, that's not what I wanted to do. I wanted to go to my large cap, and then I'm going to go here, show you a little bit of context on this. Now, I look at this fairly frequently just to get a little bit of a better sense of how the companies are doing and comparables to them. I have a lot of watch lists, as you can imagine. Financially speaking, you look at the PE ratio. Well, I should be looking at NTM, but if you look at even the current PE ratio, some of the best companies compared to look at all of them, I'm going to compare the big advertisers, right? So Google and Apple are very, very close to being at the bottom, and at the top, Tesla and AMD, right? Yeah, even Eli Lilly, but AMD, Tesla, Nvidia, very, very high PE ratio, ridiculously high PE ratio. Let me move this around and make it the other way around. Okay, so look at this, AMD very, very high. So this, that's why I told you this is going to go down. This is ridiculous. It doesn't have the EPS earnings growth to be able to support it. AMD did not have. NVIDIA does, but AMD did not have. Look at this. This is what is concerning to me. Walt Disney, CRM, I think will continue to go down. That I'm convinced about. Microsoft, Amazon actually has EPS growth to be able to support this high amount of money that is actually making on this one. Uh, Tesla is actually reasonable. It's not very bad, but its PE is not growing. And so that's going to be the challenge for them. But you look at the PE growth. Sorry, I'm just going to draw these out. Let's draw them out. Meta, we're going to put Meta on the graph. I'm going to remove Netflix is also an advertising. It's going to get to an advertising kind of a company model. I'm going to remove NVIDIA, and I'm going to add Google, Alphabet. Okay, so if you look at those are primary advertising companies. Meta has gone up nearly over the last 1 year, 135%. Google has been the least at 50%. And Netflix, I don't know why AMD is on this. I'm going to remove AMD. Google has performed the least, right? It's been the worst performer of all of them. Why? Because Meta actually, on a 5-year basis, Meta actually has done okay compared to Google, right? They've done a little bit better, not bad, better, because Meta was just beaten down quite a bit, and they've done a very good job of coming back again. So on a 5-year basis, Meta has been the best. Netflix has been the worst of these three, primarily ad-based networks. That's what I'm talking about. Apple makes a little bit of money in ads, Microsoft makes a little bit of money in ads, but advertising, large companies are Meta and Google. So you look at that performance, you can see that has to be able to get a little bit better. And compared to the two of them as well, even if you look at Adobe, let's put that in the mix as well. The PE ratio and the forward PE ratio, even for Google, is very, very compelling. They are among the best overall. So I think that's one of the things that you got to look at and say, okay, how am I going to make money on this? Is it going to be something that I have to worry about, or am I buying for something that is fairly high? And I don't think you're paying for something fairly high. You're paying at a very reasonable rate. I like Google. It's going to come back and retest this 145 zone and then probably move back in. I've held shares for a long time, so you could say that I'm a biased person for a little bit, but I like the company. I think it's doing very well. Take a look at it. Let me know your thoughts and your comments.